Assalamu alaikum. Have a good day. Welcome to Financial Management e-Learning. Today we are going to discuss Cost Accounting Module 3. So let us start. In my Module 3, we learn costing and control of material. You know, material is a vital part of cost accounting. So within this material, today we'll discuss classification of materials, accounting for materials, pricing issues of material, values of inventories. So other thing we'll take it in another module, module 4. So let us start with material. So material is anything made of matter constituted of one or more substance. It may be wood, cement, hydrogen, air, and water are all examples of materials. So sometimes the term material is used more numerically to refer to a substance or component with certain physical peripheral that are used as input to production or manufacturing. In this sense, material are the parts required to make something else. From buildings, the art, the start of the computers. So material in a stock, in regular use and will be replaced. That means a relevant cost, current purchase price. And it will not be used if not used, relevant cost, the opportunity cost, that is lost scrap value or lost contribution if you use material here else is elsewhere. Out of stock, relevant cost equal to current purchase price. So material cost, what is? Material cost paid for product raw materials. The cost of raw materials that go into product directly. The material cost of a product excludes any indirect cost, for example, overhead or wages, associated producing cost. So classification of material, we can say here, metals, polymetrics, composite, ceramics, all are material. So material can be glass, can be reinforced plastic, thermostat, etc. So metals also, that means iron, carbon, steel, aluminum, copper, all are the materials. Accounting for material, look here, purchase of material, that means purchase requisition, need, then make purchase order, then receive reports. So issue of material, materials, requisition from, supplying purchase activities for a type of trading company. And look, placing order with supplier, that means raise purchase requisition, content supplier, obtain quotation, select supplier in accordance with policy set by the organization, and generated purchase order, place order with selected supplier, then receive goods, orders together with delivery order and invoice, generate goods receive notes is the receiving goods. Look here. Then delivery notes, invoice, goods received, notes to accounts department for the checking and payment, checking the accounts department. So this is the raw materials issue. So here, purchasing procedure. First of all, a specification of materials. which material you have to purchase. The purchase requisition is come from the user. Selection of supplier, the best supplier have to select by the organization and make the purchase order with the purchase department, and receive notes, also the stationery department, and inspection for the material is it correct or not. So is the purchasing procedure of materials. Okay, so here if we see, just swallow it, contemporary view direct material cost drivers. Purchase price, it depends on supply and demand, design quality, quantity purchase, service incurred, buy selling skill, contract specification, and regularness or randomness. And quantity use, product diversity, that is size or complexity, production volume, sale volume, resource availability, resource quality and flexibility, randomness, and productivity or yield, confirm quality, labor skill and experience, equipment quality, depends, and matrix, material mixed, that's been substitutability, material availability, labor skill experience, etc. So the material cost derivers here. And now, if we see pricing the issue of materials valuation of inventory. So it's the one kind of inventory control. An inventory control system is a process for managing and locating objective or materials. Inventory control is connected with minimizing the total cost of inventory. That means inventory control is a concern with minimizing the total cost of inventory. The inventory control is the dedicated balance of cost versus profit associated with having a stock on hand. Okay, so here from the supplier, manufacturing faculty receive the goods, store the facility, the production planning and inventory control based on that, and this transport vehicle, a distribution center and retailer, a distribution and logistic. So here, inventory control is the supervision of supply, storage, and accessibility of items in order to ensure an adequate supply without excessive oversupply. Because if oversupply, it will goes for the working capital increase. So here, look, in the manufacturing, raw material stocks for the manufacture, raw material arrival and stocks, work in progress stock, finished goods stock, and goes to sales finished goods stock. That means here the revenue and costs. So why cost control is important? We know cost control important because pre-control here, look, the material pre-control stage and post-cost control stage. Pre-control, inspection, design and tender. Inspection, preliminary cost estimate. Design, comparative cost estimate. Alternative materials can be found from sub-construction and tenders with an economic limit of expenditure. Have to think it, and then construction, if that the plan the profit achieved, feedback for future cost estimation available, what cooperative action to be taken. If all question goes answer positive, then the control is think better. So here, pricing, the issue of materials valuation of inventory. Normally, a stock of material is valued either at cost price or market price, whichever is low. Okay. So pricing issue is can be their cost price method, average price method, market price method, notional price method, reuse price method. That type of we can segregate in different way. So pricing of material issue can be cost price, can be average price, can be market price, can be nominal price, can be reissue price, reuse price. So cost price is in different types: a specific price method, first in, first out FIFO method, last in, first out LIFO method, or base stock method. Here, one thing, this the LIFO method is prohibited by the accounting standard 2 inventories. So here come average price method is simple average method. We can find it total unit price divided by total number of purchases, weighted average total cost divided by number of units. This way, weighted average, periodic simple average, periodic weighted average, moving simple average, moving weighted average, this type of different types. So this is the average price method. Now market price. So replacement price method, it's the issue are valued as it is was purchased now at current price. And realizable price method, issued are valued at price if it is sold now. Okay. So notional price method, it is a standard price method, material part prices as per determined rate or a standard rate. Look, a standard rate. So inflated price method, the issue price is inflated to cover the losses incurred due to material natural climate loss. And reuse price method, when material are returned, rejected, it is valued at different price. There is no final procedure for this method. So under the cost price method, before that, the record period or delivery period or lead time is the same thing. Record period, delivery time, okay. It represents the time gap involves between placement of order and actual receipt for the delivery. Such period is again divided into maximum period, minimum period, average period, and emergency period. Okay. So now we will learn the under the cost price method. Here, number one, LIFO, FIFO, weighted average, simple average are used. So FIFO, first in, first out. This is inventory valuation method, means these products that arrive to inventories first and the first to be sold. And look here. So in FIFO, first in, first out, higher gross profit can be made, higher net income, then higher tax burden. It is very common to use the FIFO method if one trusts in foodstuff the other goods then have a limited shelf life, because the oldest good need to be sold before they pass their sell by date. Okay, so look here, within the store putting the fast, this fasting goes to the fast. So fast in, fast out. Okay, just LIFO. Look, last in, first out. This inventory method implies that the most recent received product into inventory is the first to be sold. So if you use the LIFO, then lower the gross profit because cost price of the material goes high, and that's why the production cost is high. And low income, though lower profit, gross profit, then lower net income, then lower tax burden. So LIFO has some advantages, some disadvantages. Now average cost. Average cost simply takes the weighted average inventory cost over time and assign this value to the inventory. And weighted average cost. The weighted average method is used to assign the average cost of production to produce. So an example here, LIFO, FIFO, and weighted. So is the company purchase inventory item April $2, May 2 to went to $5, and June to went to $35. In each of this month, the company purchases 200, 300, and 400 this item. The purchases are represented as the table. April, cost per unit, volume, total inventory. If total volume order is 900 unit, look, I think it's okay to you. Total inventory value 2015. Here you add it 400, 675, 940, then we'll get 2015. If leave assume the June inventory sold fast, the rate would be 2.35, this one. And if we assume the April inventory sold fast, then it goes to $2, the first on April. But weighted here, calculate the weighted average cost here. April price multiplied by volume, this show everything, divided by 900 unit. So get 2.29 weighted average cost of capital. This 2.23. Okay. So weighted average inventory is 2.38. So is the basic three LIFO, FIFO, and weighted. And in my next module, I will do some example as in math for costing. So here, look here in FIFO income statement here, sell, beginning inventory, net purchases, ending inventory. Here got net profit is 600, same figure. But in LIFO income statements, the net profit less. Look here, sell, same sell, inventory, only difference is ending inventory valuation. Look, that means cost of goods sold is higher than FIFO. FIFO is lower cost of goods sold than LIFO. So here net profit 1500, but here net profit 6500. So here's all calculation and some specification method. That means specific item have to issue from the factory to the operating machine or operation. So today we're going to close my lecture, and today we'll learn what? Learn classification of materials, accounting for materials, pricing the issue of materials, valuation, inventory. So hopefully we'll meet soon, and we'll come with next module 4 of cost accounting, and within 7 days. So take care.